After a strong showing by the bulls this week, it's a logical time to ask, have stocks finally broken out? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. On January 31st, we noted that 1976 was relevant on the S&P 500. The market did indeed eventually test 1976, and intraday price held here. The Fibonacci retracement levels tell us normal areas where the market will pull back and then resume the prior trend, which in this case was up. Longtime followers know that we were watching this trend channel. This is a post from January 15th saying there's a fine line between patience down here and risk management. The market did hold on January 15th. It was at 1992. On Friday, February 13th, after holding at a key area, the market is over 100 points higher. After the market made a stand, then we started watching 2064. As you can see here, we have cleared 2064. From a probabilistic setup perspective, we're watching the W formation, which tends to be a bullish formation, and 2064 did represent a bullish breakout. All things being equal, this is a good sign for the bulls in the short term. If you follow us on Twitter, you know we tweeted this chart here saying that this was a good-looking candlestick and it increased the odds of breaking out from the W formation, which we indeed did. We also cleared this downward sloping trend line that bounded price here, here, and for a day or two here. We noted that the Fibonacci retracement levels are logical areas where a market holds and then goes on to resume the prior trend. So therefore, if we're going to resume an uptrend, we have to make a higher high at some point. We were able to do that on Friday, February 13th. We exceeded this closing high here, which was 2090 and change. We closed on the 13th at 2096 and change. The longer this breakout holds, the more meaningful it becomes. This is a relatively long consolidation period telling us if the breakout holds, we may move relatively far in this direction. There's a reason why we have a term known as a failed breakout. Breakouts can fail, so we have to keep an open mind. The longer we stay above 2090.57, the better the odds are for bullish outcomes in the short to intermediate term. It's not all fun and games for the stock market bulls, and they still have some hurdles to cross. The good news is the NYSE Composite Weekly was able to clear this trend line, resistance, 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 resistance in the general area, and in this case we were able to break out. However, we still have not made a new closing high. So the next hurdle for the market is relatively close by. If you're a bull, you would prefer to see the NYSE Composite take out this level here, which is a little bit over this level here. One of the strongest features of using charts, trend lines, and technical analysis is they give you a reference point. Regular viewers may remember this chart from a video a few weeks ago where we looked at the NYSE Composite. These were trend lines that we drew a few weeks ago, and you can see in the last 2 trading days we have exceeded those trend lines. All things being equal, this is a good thing. These tight moving averages and this breakout tell us that the odds of good things happening have improved. The expression listening to the market is a good one. These charts can help us discern the odds of this breakout holding. Does the general market tend to agree with that bullish stance? For the most part, the answer is yes. Here we're looking at leadership. This is the XRT ETF retail relative to SPY. It's in an uptrend. Compare that to shorting the Dow, dog versus SPY, downtrend. Small cap growth, IWO relative to SPY, leadership in a bullish trend. Compare that to shorting small caps, RWM, relative to SPY in a downtrend. Consumer discretionary stocks, XLY, relative to SPY, leadership from XLY. This tells us it's outperforming SPY and has a weekly trend that is bullish. Compare that to defensive AGG, or an aggregate basket of bonds, relative to the S&P 500, which is starting to show some weakness. Same concepts here. We have leadership from S&P 500 growth stocks, leadership relative to SPY in home builders. These are weekly charts and weekly trends. An equal weight S&P 500 is doing well, telling us that it's a broad rally. Shorting, lagging. Tips, lagging. Shorting tech stocks, lagging. Our weekly S&P 500 chart has reestablished a full-bore bullish look, but we still have somewhat of a whipsaw situation in here, so we'll keep an open mind. We did hold at a logical support level, and the weekly chart was also able to print a new closing high this week. All of these things speak to probabilities, not certainties, and they tell us that the probability of good things happening is higher today than it was here. Same concepts. We're just stretching out our moving averages. You can see the dotted moving average, where the slowest is on the bottom. This is a bullish look, dotted on the bottom. A bearish look, your slowest moving average is on top. The slopes of our moving averages are turning back up, and this tight look to the moving averages tells us that if this breakout holds, we could get a relatively strong move in this direction. The support line that we were watching, or possible support on long versus short, was helpful. New high here. This consolidation period in the Dow, where it basically went nowhere for 6 months. This was resistance. Now it can be potential support. We're below the line here. Now we're trying to stay above it. We'd like to see a closing high here. Market breadth is also trying to improve. This is the percent of NYSE stocks above their 200-day moving average. When the stock market was on shaky ground a few weeks ago, we showed this chart and said it gave us some hope. It still looks good. This is new highs minus new lows in 2015, and this is the peaking process of the same chart when the S&P 500 peaked in 2007. Market fractals tell us that consolidation on a yearly chart is identical to consolidation on a 60-minute chart or daily chart. We have a lot of consolidation in here, resistance, eventually a bullish breakout, and a retest here. All things being equal, this chart, as long as we hold above this level on the NYSE composite, also leaves the door open to better than expected upside in stocks. Conversely, if we move into this level here, it would classify as a failed breakout. A quick visual on how moving averages and technical analysis can help us. This is a messy trading range here. If we add some moving averages, it helps us smooth out this volatility and classify some of it as volatility to ignore within the context of what is a vulnerable but rising trend here. These moving averages and other inputs and hard data and hard evidence helped us remain patient with our positions that we established off the October low. So on Twitter, we really haven't been buying here because we never really sold. We cut risk a little bit, but for the most part held on to our positions, hoping that support would hold. So far, it has. This is the same chart here with price removed, and it becomes a little bit easier to see the trends. So often we look at charts with moving averages or indicators only and remove price to discern the trends. We'll move quickly here, just updating regular viewers. The momentum that we track, the probability of good things happening, improves when we move into overbought territory, as we did here. Good things happen. We recaptured overbought territory this week on the S&P 500 and on the weekly chart of the NASDAQ. We still have a relatively small stake in TLT relative to our equity stake in our portfolios. These are the key levels that we'll be watching. If support does not hold here, we may reduce TLT and scale over to the equity side. As long as this holds, some patience is in order, and we'll see if the breakouts in the equity markets hold as well. Keep in mind, we have that term failed breakout for a reason, which speaks to flexibility. We'll head into next week with a flexible and open mind, but the longer we can hold this breakout here, the better for the bulls. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.